Tony, welcome back to the show.
Hey, it's great to be here, Tim. Good to be with you.
Always glad to have you and appreciate your perspective, given your experience in the industry. And we've now talked on the shows many times about the home buying process, but we're certainly in some uncharted territory with the economic conditions that we're in. And I think we have a lot of people listening, Tony, especially first-time home buyers, that it feels like the number of people that are sitting on the sidelines or have been sitting on the sidelines is really starting to aggregate and stack up. We've got stubborn interest rates, obviously some volatility, uncertainty in the economy, rent prices going up, student loan payments coming back online. And I think many first-time home buyers listening might be thinking, is owning a home, is it even realistic anymore? And so I'm just curious to hear what are your thoughts in what you're seeing and the economic conditions, obviously the conversations you're having every day with prospective buyers, and shed a light on what our listeners can take from that.
Sure, absolutely. Well, we're definitely in unique times right now. We really are. It's a fragmented economy in a lot of ways. Certain sectors are doing really well, and then there's some that are struggling. And it's the same thing with the housing market right now. We have the benefit of lending around the country. We're based in Florida, but we lend in other states.
Hmm.
And I'll give an example. You look at Dallas Fort Worth area. Some areas of different parts of there's the housing market's still very, very strong. You don't see virtually any foreclosures. It's just a lot of demand for homes. And then there's other markets that there's a lot more slack. So there is that a bit of a fragmentation. There's certain areas like I look at Florida, for example. We've been affected more by the hurricanes, the prices the last few years. There's more
Hmm.
inventory building here. So it just depends on what part of the country you are. The Northeast has been strong too, so different parts of the US have been different. But overall, there has been a little bit more of a concern among home buyers. We've had a pretty good year. We've been busy, but the temperature is definitely one of concern. And I look through the lens of my, 23 years in this industry, and I look at the housing market the last 5 or 6 years. And it's interesting, Tim, that the uncertainty, I mean, let's face it, tariffs have caused some uncertainty in certain sectors, right? Technology has been doing very well. You look at AI development, you look at what's happened
Yeah.
in certain areas of tech, that's done very, very well. But there's a lot of fear out there. Um, but when you look at more inventory, you look at, I mean, our interest rates are actually lower right now than they were last summer for the most part. Not
Hmm.
much lower, but a little bit lower. Less competition. Well, those are all ingredients for a better environment for home buyers. And I'm seeing buyers get better pricing. They're able to get the terms they want. I mean, you and I remember doing some of these recordings a couple of years ago where our clients couldn't even get sometimes an inspection done, right?
Yeah.
So now you're able to get
Hmm.
not only inspection, but negotiate pricing, negotiate a lot of different things. So the temperature overall has been better, but there's a lot of uncertainty. I think the Federal Reserve, I'll talk a little bit about that, is positioning to do a cut at some point, probably in September. And their concern is inflation, right? What are the tariffs going
Hmm.
to do? And there is areas of the economy where tariffs will affect things, and then there's areas they won't. And then you also I look at the decade of 2010 to 2020, where interest rates overall were lower. And a lot of that was because technology helped reduce inflation. And I think that's what you're going to see with these developments in AI and other technology is over time, it's going to help inflation pressures. But tariffs in the short run really could affect things, right? So that's what's causing a lot of the uncertainty in many of these sectors, including my sector, right? Real estate, mortgage banking has been under
Hmm.
pressure for a while. So there's a lot of uncertainty for
Hmm.
people in our world, so different sectors are facing different pressures.
Yeah, and I think it's worth, Tony, highlighting, as we say every time on the show, but perhaps more now than ever, reminding people that every single market is different and unique. And when we talk in generalizations about the economy, especially when it's so emotionally driven right now, the fear that you talked about, I think the US population is more informed about tariffs and interest rates than they've ever been, right? Because
Great.
it's front page in the news pretty much every day. And, being informed can be good, but it also can be driving a lot of fear and uncertainty.
Sure.
And that may or may not be representative of what's happening in your town, your neighborhood. I mean, obviously, to some degree, the generalizations apply, but every single market is different. And I just think we have to be careful about some of the anecdotal, hey, in this market's happening, this is happening, and therefore we apply that to the entire country. Every population is different. Everyone's budget is different. Obviously, what we're seeing in terms of competition and price stabilization can be different in every single market. But I do think, as you pointed out, there is certainly some silver lining in what's happening and what's been out there. And one of the things that I like to remind people about, and we've got to be careful, as we always say on this show, we don't want to buy before we're ready. Certainly, that's not what we're suggesting. But also, let's remember that home prices historically and likely will continue to appreciate over time. And so sitting on the sidelines, sometimes that's a valuable move because we're getting ready to buy and we want to make sure we're doing that from a position that's financially sound. Absolutely. But other times, if we're ready, and maybe that's driven by fear because we don't like the interest rates and we're waiting for the 3% days to come back, which probably aren't going to be happening at least anytime soon. All the while, we're just sitting on the market at a time where we're not able to build up some equity, and these prices just keep going up over time. And it kind of reminds me of what we talk about on the investing side, trying to time the market versus doing things like dollar cost averaging. Like if we sit out and wait too long in terms of trying to time the market, we wake up 2 years later and it's like, oh man, we could have got that back at a lower value and we just missed out on the appreciation that happened in the market over time. So it's this delicate balance, right, that we're trying to find as a prospective home buyer.
Absolutely. But you nailed it right there, Tim. I mean, the individual buyer has to be ready no matter what the market is. You don't want to look at it as, well, it's a great time to buy, I should be buying. And if you're not ready, don't buy, and it's the other thing is if there's a lot of fear, generally speaking, my experience in real estate and investing has been when there's fear, it's a good time to buy. That's usually the best time is when there's fear. But at the same time, you've got to be ready, right? You have to be in a position.
Yeah.
One thing I'll say is with home buying, if you're going to live in a market for at least 5 years, I think it's a no-brainer to buy because over time, the amortization, the principal payments, even if you had no appreciation, is generally going to really benefit you over renting during that time because you're going to be paying a lot of rent, and rents generally escalate. They don't stay flat, so you're going to probably see your rent rate rise over 5 years where you can fix in your cost and maybe even lower your cost if rates drop, which I think will happen at some point. There'll be opportunities, but yes, every market's different. The consensus though, overall in our country right now is we're having some of the lowest resale rates of the resale market at some of the lowest points in the past 30 years. So that means the resale of existing homes is at the lowest point. And part of that is there is a little bit less inventory because people that have owned homes that locked in at lower rates, they're not listing their homes. And that's another part of that equation too. So but I think there is some fear among buyers. But at the same time, I step back and I think for first-time buyers, this is a much better entry point, probably the best one since, pre-COVID that I've seen.
Right.
During COVID, it's been kind of madhouse, but since that time, this is probably the best entry points I've seen, most in some areas. So.
Yeah, and the other thing I keep thinking about, just as I look around my own neighborhood, I've actually seen kind of an uptick in properties going for sale. And the thought that's coming to mind, obviously a very small sample, is that, the thought that people are staying put because of their low interest rate can only last for so long, right? We've been talking about that for how many years now?
Sure.
And life changes for people.
Yes.
People have to move because of job opportunities, family changes, just people getting older and downsizing homes or whatever it be. And you might be able to delay that to a point, but over time that's going to break, and maybe it breaks slowly. Maybe it breaks a little bit faster if we see a reduction in rates that happens. But nonetheless, like that will over time, right? We'll see those existing homes recycle. The other thing I'm just noticing is the volume of building that's happening. And not inexpensive building. It feels like there's a lot of building that's happening that is a lot of kind of prototype homes at a very high cost. And I'm guessing that's just playing directly into a lack of inventory, right? In a lot of markets that's out there.
I agree. Yes, the builders have done relatively well the last few years. They're seeing a little bit of a hit this year because that even new home demand is slacking more than it has been. But
Yeah.
the builders is really who came into the market and said, okay, the resale market, the inventory levels are low. We're going to take advantage of this. We're going to build new homes. But they're even seeing a little bit of a hit this year. New home construction has been hit a bit. But yeah, that's there. And then you got to remember we're still underbuilt in most markets, Tim. If you look at our population growth, it's hard to believe this, but
Right.
in most markets, we still don't have enough housing. And that's why that you see these builders still doing very well, especially like in more high growth cities, that have that they haven't been overbuilt. That you're seeing that there's some cities that are overbuilt, but the builders are still doing very, very well in some of those markets. And I'll take Florida, for example, because so obviously I'm here, I've been here for most of my life. And it's, we dealt with high insurance costs, but they're starting to change. The legislation's changed here. That's one thing that a lot of people don't know is we're actually going to probably see insurance costs drop, even with all this hurricane stuff we've had, because the hurricanes didn't impact the hazard insurance carriers as much as it did the flood policies, right? So it's and the legislation changed here, and there's more carriers coming back, which lowers prices. So I think over time you're going to see this. There's also something being kicked around that's eliminating property taxes in Florida, which is going to be a major boost to home demand. Again, it's got to pass next fall, but you just don't know what could be a catalyst. And I think that certain areas are going to get better over time as we go into this. But I definitely, you're seeing falling prices in different markets, and that's going to help buyers. And I think interest rates are going to be they're in a better position than they've been. And there's a possibility they could be better. I will say that there is always a chance rates can go up if we see inflation, right? Or we see things rocket the other way. Inflation's the one big enemy of rates. So we just got to watch that. If that continues to go down, rates are going down. But if you see that start slipping higher, then that's going to cause rates to go up.
It's interesting on the property tax. There's actually some similar legislation moving here in Ohio. Probably looks different, but similar discussion around property taxes. And I was thinking about you guys in Florida. I mean, obviously a lot of demand there already, but no state income tax. Imagine there's no property tax and the interest that's going to be to move to Florida.
I think it might be. We'll see what happens.
Oh man,
it'll be interesting.
Yeah.
Sure. We just need no storms this year. On the west coast of Florida, if we can get we had those 2 hurricanes last year. It was pretty rough.
Yeah.
But it's created opportunities here. I mean, there's people that have been able to get better deals on some real estate, in those areas. So it's, and we just need to heal. It's been hard. I've had a lot of clients that have been hit in those areas too. It's been hard to see.
Yeah. You mentioned being ready, and I want to talk about that for a moment, because I think for everyone who's been sitting on the sidelines or maybe just more recently is thinking about buying a home, but is looking at the market and saying, hey, we're working towards getting ready, but not necessarily at the point yet to put in offers and make that decision. One of the things that I've come to appreciate is being on the sidelines is anything but a passive posture, meaning there's work to be done, right? I'm thinking about things like making sure that we're planning for, down payment, thinking about credit optimization and really putting ourselves in a position to be the best borrower that we can be and be in a position to buy the home and certainly get the best terms that we can. So what would you say, Tony, to those that are prospective home buyers that are sitting on the sidelines? What are some things that they can be doing from the lending perspective to really be ready and be a competitive buyer?
Yeah, that's a great question. I would say what you mentioned about, knowing your credit scores as best you can, knowing one thing about the credit optimization, with credit cards, it's, and I've given this story before in the past, but like my personal journey when I was younger in my early 20s, when you go to a store and you say, let's say it's Best Buy, whatever it might be, and they say, well, we'll give you can buy this $5,000 worth of appliances or whatever, furniture, whatever it is, and you have no interest for a year, no interest at all, right? Well, it appears to lenders as a $5,000 maxed out credit card. So let's say you bought $5,000
Yeah.
of goods, and that typically hurts your credit because your credit utilization is zero. You're at a position where you're maxed out, and that looks bad to the credit bureaus, right? So that can be good for 30 or 40 point decline. So know what your utilization is. If you have a credit card with a $10,000 limit, keep it at 50% or below, knowing that you're trying to build your credit score. Pay everything on time, right? The more you can put on ACH automatic withdrawals so you don't forget, the better, right? That way you don't have any missed 30-day lates. And then, student loans, right? I know, and we'll get to that. I know I probably should wait, but I just know what you're dealing with, right? What is your situation? Am I in deferment? Am I in forbearance? What position am I in? That way there's no student loan payments missed. And I can address that further on when we get to more detail about that. But you want to make sure you know what your payments are, know what the lender is seeing, because the debt to income ratio is very important. The other thing is your down payment. Make sure you have a down payment in place. A lot of our products require very little down payment, but you want to still be able to source that, whether it's a gift from a family member or whether it's, something you're saving or withdrawal from your 401k, whatever source that down payment is coming from. And, your job stability, the nice thing is most pharmacists typically have very good job stability and location stability.
Yeah.
They're not being relocated across the country like some positions are. And that gives you more time, when you're going to be in a home for a while, typically is a very good investment for time. So knowing that you're going to be there 5 years is usually the marker. I'll tell people if you're 2 years or less, I would rent, or even 3 years or less. But if you're going to be there for at least 5, you should own. So, but those would be some of the planning I would do, just to kind of look at your situation, make sure your credit's in line. And if you need to enhance your credit, there's ways to do it. And there's things we could even do and other lenders can do, tools that we have to help you improve your credit.
It's a great list, Tony. And I think building on the down payment discussion, this is a great window of time to be working the budget.
Yes.
Working the budget for what will it look like once you move into the home. So if we model out a scenario where you buy a home that's X and you put this much down, right, on a 30-year fixed rate loan at, X percent, what will be the principal, interest, tax, insurance, monthly payment? How does that fit into the budget? And then also short term, how are we going to save for the down payment? This is something that comes up a lot where I'll talk with especially prospective first-time home buyers who say, yeah, I have a goal of owning a home, let's say in the next 24 months. I'm like, hey, that's great. Tell me more. Like, what are you thinking about in terms of home purchase price? What's going to fit in the budget? What are you thinking about in terms of, your term, your length of your loan? And what do you think about in terms of down payment and options that are out there? And usually that's where the conversation stalls out, right? And the point that I'm often making is, hey, let's say you're buying a $500,000 home. If you're putting down a conventional 20% on a $500,000 home versus you're using something like the product we'll talk about that you guys offer that you might put down 3% as a first-time home buyer, holy cow, that's a big difference in terms of like what's going to be needed as well as how you're going to make that happen, right? Whether it's you're saving up month by month, whether it's a gift from a family member, whatever it might look like. But that's the type of specificity we need to get into so that when we get to the point of, hey, we're ready to buy and we know within the price range of what we're looking at, we can go out there and do it confidently and knowing that we've thought about it in the context of the rest of the financial plan. So again, anything but passive, right? When you're on the sidelines, this is the time to really be looking at things like credit, working the budget, figuring out how this decision will fit in with the rest of the plan. And I do want to talk about student loans. You mentioned student loans, and man, this is a time period that is just extremely confusing for borrowers. So many changes. We talked 2 weeks ago on the podcast. We'll link to that in the show notes, episode 416. I hit the highlights on the changes that have come, will be coming from the big, beautiful bill. And it is, for many borrowers, a period where even as I try to explain it on the podcast or present it, I can kind of see eyes glossing over and like, I don't even know where to begin, right? And for a lot of people, they've been in a period of time where they haven't had to make payments or interest has been frozen. They've been on a forbearance, and all of a sudden things are moving, right? For those that were on the safe forbearance, interest started accumulating back on August 1st. Others are entering into active repayment, going from a no payment to all of a sudden I've got a sizable monthly payment, which makes sense if you've got a couple $100,000 of debt. And then, of course, we've got the future changes coming next July and beyond, which is going to put a wrench in what does the future look like with student loans. If we then put all that together, Tony, with buying a home, obviously a big part of the lender's decision and what someone can afford from the lender perspective is how does your total debt factor into the equation relative to your income. So how are you as a lender right now handling the chaos that is student loans? And what are maybe some of the questions that you're seeing and hearing from prospective home buyers that our listeners could benefit from?
So it's a hot topic right now with our clients who have student loans. A lot of our professional clients, pharmacists, physicians, dentists, attorneys that carry some of that student loan debt. And one of the things that I'll mention number one is the credit report that we see doesn't always reflect what we have to count for the student loan debt. And a lot of times we'll run student loan when we run the credit report, it'll give us a number, but that's necessarily not what we can use, right? And it depends on the product, but one thing that's typically the income-based repayment plan is going to be what I find is the best one for most. And because sometimes we'll see a 0 on the credit report, right? Because that student loan is in forbearance, it was in deferment, whatever it might be,
Yep.
and it's a 0. And there's one program that sometimes we can count 0, right? That we can actually use for 0. Then there's others that we use a factor of 0.5% of the balance. So if you have $100,000 or let's say $200,000 balance, it's probably more realistic student loan balance. That's $1,000 a month that the lender is counting against you in your debt to income ratio. So include that with your car payment, credit card, and your new mortgage. That eats into a lot of what you can afford. So that factor may not be what you're actually going to pay. So that's what a lot of lenders look at. And I will say this, like FHA and some general products that are out there, they're 1%, right? So there's some products that are even higher that are general. These other ones I referenced are more specific, but I would say that depending on the situation. So for example, if that income-based letter is very important. So that tells us what you're actually going to be paying, right? And that can benefit you if the student loan payment's high. Like there could be some that are higher, and that actual income-based will lower the number. So that would be my advice. From my perspective, from our perspective, we want to stay away from using ratios. So we would obviously try to trend to those programs that reduce that impact. But if we can't, then getting that letter is important, stating what the payment's really going to be. Because if a lender has to use, I'll speak in general terms of any lender, if we have to use these ratio factors, it's going to penalize most buyers, So the lending community, I'll just say I'll represent that like all lenders. If you go to a lender, they're going to look at this and say, oh, a 1% factor because the student loan is in deferment. Well, that's going to really affect that individual's buying capacity. So really know your situation the best you can would be my advice. Like know where you are with your student loans, because we've had some clients come to us and they just haven't been prepared, and we're having them get letters and they're scrambling and they really didn't know where they were with things. And I will say this too, I've had numerous clients that have had issues with their student loans where they showed late payments because they weren't really on it, with what that transition was doing. So we've had to work with them too on that as well. So just knowing that empowers you, and you just want to really have that understanding of where you are. And to be candid, I have to watch your episode on the student loans. I'd love to, I'm familiar from the lending side, like what we look at, but I really want to understand exactly what everyone needs to do. Cause I like to know, like the information. So I would recommend everyone review that too.
Yeah, what I'm hearing here, Tony, especially while we're in this period that's so dynamic with these changes and information's forthcoming, that's giving us new insights, and again, a lot of the changes from the Big Beautiful Bill that we talked about on
Yes.
episode 416, a lot of those are July 2026 and beyond, and exactly when those are going to happen is
Right.
not even entirely clear yet. So we're in this weird interim period, which is hard from a prospective home buyer because we like to have stability, right? Stability of the budget, stability of the student loan payment, even from a lender, stability to know that their situation's not going to change. And right now, everyone's situation is changing. And I think that makes it so difficult, not only to the lender, but to the borrower to try to figure out, again, back to the question we've been talking about, like, am I ready to buy? And you might have been, someone might have been on a $0 payment, frozen interest for a long period of time. And this is such a good example where two parts of the financial plan come together and we can't look at them independently, right? For instance, if you have $200,000 of student loan debt and you opt into the standard 10-year repayment plan, your monthly payment's going to be a fixed monthly payment for 10 years of roughly a couple $1,000s per month, right? Now, if you look at that alone, some people might say, hey, that's what I want. A lot of people won't, but some people might say, hey, that's what I want for student loans. But then when you zoom out and say, hey, how does that fit in the context of buying a home? Probably not going to help us from a lending standpoint, right? Because if I can opt into an income-driven repayment plan and I can have a lower monthly payment, even if I choose to make extra payments, that lower monthly payment per the calculation, per the paperwork you talked about, is going to be more favorable from a lending perspective, right? Because it directly feeds into the debt to income calculation. And that's what we have to remember. I know we've talked about it in previous episodes, but your debt to income ratio of which the lender is looking at as a percentage, we're talking about all debt. So not only the home that you're going to purchase, but your student loan payment, if you have credit card debt, other liabilities that you owe, there's obviously only a maximum amount that the bank, for good reason, is comfortable borrowing, and that you as the buyer should be comfortable taking on as a responsibility. So there's strategy here. Again, we want to be ready, but there's strategy here to figure out how can we optimize this to be an attractive lendee in this process, especially for many of our listeners who are first-time home buyers that very well could have a couple $100,000 of student loan debt. So different pieces of the puzzle have to come together. And I think this example, Tony, is such a good one where you don't want a generic lender in service that you can't pick up the phone and have a conversation with about these things. We've talked about this before where, hey, you might be thinking about a certain product, but because of what's going on in the market, a better product may be a better fit. And having that type of customization is really helpful. Here's another example where it's a confusing time period, lots of questions, probably more questions than answers. And can I work with a lender who understands kind of what's going on and isn't just necessarily applying, a rote generic calculation that may or may not be representative of what's actually going on in their situation? So a lot to consider here.
It's a lot. And you're right. You have to customize for the client because you may want to take it one program, but you have to say this program's better due to the student loan situation. This is the only way it's going to work.
Right.
And I think that's, we try to give those options because there's certain programs that will be more flexible than others. And it doesn't necessarily mean that it's the best, a lot of times that's going to end up being not only the best rate, but the best program. So it's like, there's a lot to it. And I think we try to look at the whole picture. It's very critical that you do that. You have to. And it's very customized. You can't put everyone in one box. And you want to take time. You want to make sure you figure out a plan for them. It's our job. I see our job as problem solving. It's problem solving. It's helping people. We're not here to just say that one size fits all. You have to, because there's tremendous amount of troubleshooting and problem solving and planning on our side of the fence to make sure people get the right program.
I know for people that are sitting on the sidelines and, maybe loosely looking, hey, I'm thinking about buying in 3, 6, 9, 12 months, whatever it is. Typically how this process can go, especially for first-time home buyers, I've been there, I get it, is, hey, I'm thinking about buying in 6 or 12 months. I don't necessarily have a lender in mind, not really thinking a whole lot about the product. I'm just casually looking and then boom, like the right property at the right time. And now we're chasing everything, right? We're trying to back into quickly getting a lender, making sure we get pre-approved. That's going to require a bunch of paperwork. And so just general thoughts that you have for those that are in that, hey, I'm casually looking phase, both in terms of what the right timeline is and when to engage with a lender and some of the things that they can be doing behind the scenes to prepare what inevitably will be some of the documentation and paperwork that they're going to have to submit to ultimately get pre-approved.
Yeah. Yeah. I think we touched on some of this earlier in the discussion, but I think it's super important to have your credit, report kind of lined up. What are my liabilities? What am I paying? What's my credit scores? Just having an overall idea. I think from an income standpoint and documentation, make sure you have 2 years of your W-2s, and if you have any self-employment
Mm-hmm.
income, 2 years of your tax returns, you can start getting those together. If you're on extension for your tax returns, uh, make sure you have a profit and loss if you're self-employed, if you have self-employment income.
Mm-hmm.
But W-2s are typically what we'll be looking for. Tax returns if you're self-employed, bank statements covering a 2-month period, most recent 2-month period for financial bank statements and like financial assets like brokerage accounts, anything like that, 401ks.
Mm-hmm.
And you know, and just making sure, for example, with your employment, if you're going to be moving employers, I had a client of mine ask me about that recently. We're looking at doing a refinance for him, and we've worked with him in the past. And he's been in a line of work where he's been in this for a long time, but he's jumping to a new employer, and there is some incentive pay for him. He's not in the medical field; he's in the business
Mm-hmm.
world, but you know we can always use, if you're staying in the same field and you're W-2 and you're salaried, we can use that same salary at the new employer. We can use it transferable. But when you go from something where it's all variable pay, commissions or
Right.
bonuses, and you're going to a new employer and most of your compensations, commissions and bonuses, that can be trickier because you don't have the track record yet that you have established at the other company. So
Yep.
people have to keep that in mind too, depending on your situation. Just make sure you have your employment lined up, and you could be
Mm-hmm.
starting a new employer. A lot of first-time buyers come to us. I'm working with a few physicians that are just out of residency right now. They're starting in September, and we're helping them. They have a contract for employment, and I've seen that with pharmacists too. If you have contracts,
Yep.
you can provide that to the lender, and they can start getting ahead of things on the pre-approval. So just having your financial picture buttoned up, your credit, I think is a good planning process. And then just coming back to knowing where you want to live in your community, like start looking around a little bit and getting familiar with different areas. And I think that's important too right now, during this
Mm-hmm.
process.
Great stuff. And I think for many pharmacists that are listening, one of the advantages that they have when you're talking about the variable fixed income is so many pharmacists are on, W-2
That's
income,
right.
pretty stable. Often will have two, incomes in the household, not always, but certainly that may be the case. And, I think that really helps. That stability of income, of job history really helps when it comes to the lending side. So really good stuff right there. I want to wrap up by talking about the First Horizon Pharmacist Home Loan for those of our listeners that aren't already familiar with it. And I already highlighted one of the main benefits for first-time home buyers. That would be the 3% down, 5% for those that aren't a first-time home buyer. But tell us more about some of the requirements around the Pharmacist Home Loan product in terms of credit scores, max home purchase prices, and certainly our listeners also get more on our website, yourfinancialpharmacist.com/home-loan. We'll link to that in the show notes. But give us a brief overview of the First Horizon product.
Sure. So currently if you're a first time home buyer, you could do 3% down, with no PMI. If you've owned before, it's going to be 5% down with no PMI. And then there's no prepayment penalties on the program, on the loan product, meaning you could refinance or pay it off at any time. The max loan amount typically will follow the max conventional loan amount for the region. Across the country currently, it's 806,550. So that would be the max loan amount around the country for the most part. There's certain areas that'll be a little higher. And then the minimum
Mm-hmm.
credit score is 700. So 700 is the minimum credit score. And, having the no PMI creates a tremendous amount of flexibility. And typically we don't have much of a reserve, if any, reserve requirement. And what that is having several months of mortgage payments in reserves. And some younger pharmacists, and pharmacists in general, it can be tough sometimes to have a lot of reserves in place. And as Tim mentioned, the great thing about the community is, most pharmacists are on W-2. I did bring up the self-employed because I have had a few that have had some other types of
Absolutely.
income, or a spouse that has, but you're absolutely right. It makes it much simpler for lending, because self-employment is much harder to underwrite for lenders. And this product is a very easy fit for most people, so pharmacists. So we always try to find the best product. I don't always assume that this is the best one. We look at everything.
Yep.
And there could be something else that's better.
I'm glad you mentioned the reserves, Tony. That was something that caught me off guard the first time we bought our first home back in 2009. It was all that work to save the down payment. And then it was almost like a surprise. It felt like, oh, by the way, like we also need to have proof of reserves. And to your point, is often a first-time home buyer, there's, enough of a challenge to get together that down payment, let alone other reserves on top of that. So I think that's a benefit. Again, just to highlight the key points on the First Horizon Pharmacist Home Loan: 3% down payment for first-time home buyers, 5% for non-first-time home buyers, no PMI, 30-year fixed rate mortgage option available. Tony mentioned the max loan amount in most areas just above that $800,000 value. And then one other important fact, knowing that we got listeners all across the country, is that this option is available nationwide except for our friends in Alaska and Hawaii. So again, we've got some great information on the website, not only related to this product, but also just getting ready for that home purchase that I think our listeners will find valuable. You can get that at yourfinancialpharmacist.com/home-loan. And that resource is 5 steps to getting a home loan. So make sure to check that out, and we'll link to it in the show notes. Tony, as always, love having you on the show. Love the perspective that you bring. And obviously you've been a great partner at First Horizon, and really appreciate the time that you take to do this.
Thank you, Tim. I always love being here with you and enjoy this time. So happy to help. Thanks for having me. Appreciate it.